So for all in attendance today who are between the age of 35 to 50, this is a very important time in our lives, personally, but also financially. So whether you are juggling the time constraints and higher costs of starting a family or having growing kids who are in extracurricular activities to dealing with unexpected expenses which can arise, I oftentimes find these times put families in a very tighter financial situation, or for some, this can kind of put them underwater, in which they have to rely on debt to kind of pay for some of these changes and some of these expenses. And on top of all of this, we should be balancing our savings for retirement, which can often be easily kind of pushed aside. So I want to share this quote with everyone today from a politician by the name of John Beckley, where most people don't plan to fail, they just fail to plan. And we are often juggling time between work, our families, and friends. And I get it. It can be hard to kind of find that time to put a plan in place for all the important things in life. So this is kind of where your financial advisor can really help you create a plan for all the important goals in your life and help you achieve them. So whether it be goals you want to achieve while you have a family, or it could be your retirement dream. And having that formalized plan in place will provide you with that roadmap on really how it all kind of comes together. And it provides more predictability to what your financial future will look like. So we'll start our discussion today around risk management and how insurance and estate planning will play an integral part in managing risk for you and your family, but also mitigating risk in your retirement plan. We'll also have an in-depth discussion around financial planning, as financial planning can look very different during the years when you start a family, as your family grows, when you start to become empty nesters, and essentially as you kind of start entering your pre-retirement years. So one aspect of risk management involves incorporating insurance to protect yourself as well as your loved ones. So there's three different types of personal insurance coverages you typically should consider obtaining in order to protect yourself, your family, and your ability to earn an income. So the first is life insurance. Life insurance can serve many purposes, as it can help to cover for funeral expenses, to pay off any existing debts, which is usually where most individuals look to obtain coverage, is when we have some debt. To provide for family survivorship needs to your loved ones, but also to help your children pay for the current or future educational expenses. And this will be more so if we happen to pass away at an earlier age. There are various different types of life insurance coverages which you can obtain, and life insurance can also be utilized for various purposes. So as an example, as we get older and continue to build assets, which can be in the form of like a rental property, a cabin, or possibly farmland. And if you intend to keep these assets and pass them to the next generation, you probably will most likely come across a tax issue upon death. And life insurance can really be a great solution for this kind of future tax bill. So this is another area kind of where your financial advisor can kind of guide you through the process. Next is critical illness insurance. And this type of coverage is important as it provides an injection of cash to help pay for expenses when you're sick and unable to work. So we often refer to critical illness insurance as an insurance for your retirement plan, as it provides a tax-free lump sum injection of cash to help pay for those ongoing living expenses, or out of pocket or out of country medical expenses as well. So this prevents you from relying on or possibly depleting your savings and retirement assets, or even worse, having to rely on debt to pay for some of these expenses. So critical illness will provide you with that income replacement while you're taking time off of work to kind of focus on recovering. And another consideration is that oftentimes, if we do get sick, it's not just a loss of one spouse's income in the family, as your spouse will most likely take time off of work to be with you. So it's a loss of one and a half or potentially both incomes should a spouse get ill. So this is why you should consider obtaining this type of coverage today while you're younger and healthy, as the coverage can be quite affordable. And for our pre-retirees kind of joining us today, it's very common to obtain coverage leading up to retirement or during the early years of your retirement in order to protect and insulate your retirement plan due to a sudden change in health. So the most common types of claims today, which may not come as a surprise to many of you, are for cancer, heart attack, and stroke. However, there are many other kind of common cover conditions, as many policies offer coverage for up to 25 different cover conditions. So MS, Parkinson's, major organ transplant, heart failure too as well. I mean, those are some of the common kind of coverages. So next, we'll kind of have our discussion around disability insurance. And many of you will have disability insurance coverage through work, but I will always caution my clients on how much you want to rely on your group disability coverage, as there are some limitations to this type of coverage. And depending on your occupation and income, you might want to look at securing a personal policy, which will provide you with a much more better comprehensive coverage. So if you're a higher income earner or a professional on this call today, we often recommend securing a personal disability insurance policy to supplement your group disability insurance coverage.
Taylor, you touched on it on the disability side, but I often get the question also on the life and the life insurance and the critical illness insurance, of people who think that they have enough coverage because they have, great coverage at work. But can you touch a little bit why maybe to evaluating that on a personal side is important?
Yeah, it's very important to evaluate. You mean for a lot of individuals joining us today in our 35 to 50, it's not uncommon nowadays to potentially work for multiple different employers before we retire. And you might be jumping from one employer to another employer where they may not offer maybe a really good benefits package with life insurance or even disability coverage at all, or even critical illness, which is kind of the least common, I would say, out of the three coverages. So having that personal policy is beneficial in the fact that it follows you. It doesn't follow your employer. It's the portability of it, and you keep that coverage and it follows you wherever you go rather than your employer. So another aspect of risk management that we'll talk about today is estate planning. And basic estate planning often starts with obtaining 3 legal documents that many Canadians do not have, but are critically important. So the first step is to obtain a will. And a will is a legal document that sets your wishes regarding the distribution of your property, and it can involve the care for minor children. And if you die without a will, which is often referred to as intestate, your wishes may not be carried out as you had hoped for. So a lot of individuals, I guess we run into this a lot of times in the group side, is if you get married or you happen to get divorced and you don't even update your beneficiaries, the last thing that you would want sometimes is maybe having your life insurance proceeds or your assets going to your ex, right? So you may always regularly review as simple as beneficiary designations because you want to make sure they're going to the right individual. But further, your family may end up spending additional time, money, resources in order to kind of settle your affairs if you do not have a proper will in place. So about less than 1/3 of Canadians say they have any formal estate plan, and less than half of Canadians have a will. So statistics show that about half of you on this call today do not have a will. Another important document you should have in the event of an unexpected emergency, so a health scare, or if your mental capacity is in question, is a power of attorney and healthcare directive. So your power of attorney, or POA for short, and healthcare directives are legal documents that give another person which you trust the power to represent you and the ability to make decisions on your behalf in the event you are medically unable to do so yourself, or in the case of a power of attorney, it could be that you're out of the country for extended periods of time, such as snowbirds, for example. So there's various different types of power of attorneys which can be exercised under certain circumstances. So you just got to make sure you obtain the correct ones that apply to your situation. And if you don't have any of these documents in place, you should really be speaking with a legal professional to kind of start the process. A lot of people, they tie into getting these legal documents, say when they start a family, right? And the family grows, but not necessarily. Even if one of your big life events, such as getting married, or if you're single and you've just built up a lot of assets, you know what I mean? It's very much so applicable to you during those situations where you should look at speaking with a legal professional to start the process and obtaining some of these important legal documents. Or for some of you who have all these legal documents already, and it's been many years since you last reviewed them, and your family circumstances may have changed since then, you should be really reviewing and updating your legal documents. Most times, either something significant changes in your life, or at least a good practice kind of every decade or so, because a lot can change kind of over that time period. And many of you kind of joining us today might have, elderly parents who are getting older, or who might be showing signs of a decline in health. And it would be a really great idea to ensure that you have this conversation with them to ensure that these documents are in place, or that have been recently updated. And I would really say that if you're a power of attorney for your parents, or if you're an executor, it just makes your duty much easier at that time to ensure that you're kind of having that conversation and making sure all those important documents are being updated then. So as we all know, life moves pretty fast. So when it comes to financial planning, this will often look very different for every individual and family. So your plan should be reviewed and updated accordingly. So everyone has a different family with different goals and different dreams. So what you want for you and your family is different for everyone, and life can change quickly. So as we get older and enter into our pre-retirement years, our priorities and goals can change, and many become fearful of kind of what retirement might look like and whether they're on track to retire. So retirement planning is a major component in overall comprehensive financial planning. And most individuals will share one common goal, which is to eventually retire. So this should often not be left too late during your family years. And hopefully you're not starting in your pre-retirement years. So your retirement plan or your financial plan is ever evolving, and it rarely stays stagnant. So as your life and again, financial circumstances change, so should your financial plan. And that's why financial advisors are here to kind of help you with every step along the way. So when we look at your own personal finances, whether it be your family years or pre-retirement years, there are several financial resources which you will most likely be invested in, whether it be today or in the future. So the first is what most of you are probably familiar with, which is your company group retirement savings plan. And it's great that your employer offers this plan to you, as not all employers do. But if your company currently does not offer a pension plan, or if you're looking to make some changes to your existing company pension plan, I would really strongly suggest getting in touch with Danielle. As many of you know, she is our group retirement services specialist in that area. So if you find yourself in this situation, please reach out to Danielle. Next, we kind of have your personal RRSPs and TFSA accounts. And for most Canadians, these accounts will comprise the majority of your investment or retirement assets. So last year, a new account became available to Canadians, which is called the First Home Savings Account. And for those who have not purchased your first home, or have sold your house many years ago and are looking to purchase a home again, this will be a great account for you. Typically, it's kind of like a 4 calendar year period from when you sold your house. to when you're looking to buy again, where you would qualify as kind of a first home buyer. So if you haven't looked into the FHSA account, strongly encourage you if that is applicable to you. And many of you may not be familiar with the Registered Disability Savings Plan, but roughly 30% of Canadians age 15 or older has had one or more disability. But few know that if you qualify for the disability tax credit, you are eligible to apply for the Registered Disability Savings Plan, which offers very generous matching government grants and bonds. So if this is applicable to you, I would strongly suggest finding out more about the RDSP account and speak with your financial advisor. Next, we have your kind of typical checking and savings account. As a general rule of thumb, it is good practice to typically have about 3 months worth of your salary in a savings account to kind of help with any future unexpected expenses. But you never typically want too much cash, as we call that kind of lazy money. Probably better utilized in your RSP, TFSA account, or other kind of investment accounts where it could provide you with a much better longer term growth. There are many non-traditional banks which offer accounts with no monthly fees and with higher interest rates, which you really should consider. So if you're kind of in a traditional bank account, you always look at your interest rate and you're saying, hey, Taylor, I'm getting about 0.5% or maybe 0.7%. There are a lot of many non-traditional banks which do offer great accounts, such as Manulife Bank, EQ Bank being another one, and Tangerine, probably common names that everyone on joining us on this call has heard before. So really kind of look towards really kind of in the basics of how can we generate a higher return just with some of our savings. Some of you here might have additional real estate, which produces rental income, or you might come from a family farm background and you either currently own land or will be inheriting farmland, which will provide you with a source of income in the future. Others joining us today might have another job, or you might have contract work or even a side business to kind of earn an extra income. And then last, we kind of have future inheritances. And we're all aware that our parents and grandparents are getting older. So you might be expecting a future inheritance. Statistics show that roughly 60% of Canadians expect to inherit money with an estimate of about $1 trillion, which will be handed down to the younger generation over the next few years. So what is more important is how do most families kind of put this inheritance to best use? So whether it be debt reduction for yourself, retirement savings, or creating additional wealth from the family inheritance, which can be passed on to the next generation. A lot of it is what are you hoping to accomplish with that inheritance that you might be receiving.
Taylor, a question that comes up a lot is, especially in this age category, when maybe, incomes are starting to get a little bit higher, some savings become a little bit more realistic for people. And it's always the debate of RSP versus TFSA and which one is the better avenue if you have some additional cash you're looking to save. Can you share some thoughts there on kind of which one is better in different scenarios?
Yeah, great question, Danielle. It is a very common question, and the simple answer sometimes it's very much dependent on your own personal circumstances. Oftentimes, we look at contributing into RSPs to get that tax deduction, right, to get that tax relief. And in a perfect world, when we file our income taxes, you should be a $0 owing and a $0 refund, right? That way you've maximized your taxes. But realistically, what we're hoping to try to achieve is that if you find yourself in a situation where for your income taxes, you are owing, you might need additional deposits into an RRSP to have that additional tax deduction to generate a refund or to kind of hopefully wash out that taxes. And if you are getting a refund already, a lot of times it depends on if we're wanting to generate a higher refund. But rather than generating the higher refund and using that higher amount of money and spending that on a vacation or buying something that's a want versus a need, it should be generating a higher refund to hopefully reinvest that money or for debt reduction. So it really ultimately comes down to what are you using that extra tax refund for. So a lot of times we're looking at RSPs to kind of offset those taxes, and then we would typically look at TFSAs afterwards once you've kind of taken care of the tax man per se. All right, so moving on here, when we are at the stage of our lives, when we are kind of starting a family, or as our family continues to grow, we often look at the need to either purchase a house, which might be applicable to some of you joining us today. Some of you might be looking to upgrade to a bigger house because the family's growing, or renovations might be needed on your existing home in order to continue to support your family. For most, this often requires taking on debt in the form of a remortgage, refinancing, line of credit, or potentially using your credit cards to kind of finance these expenses. But many Canadians have debt. But once we have debt, we should then be focusing on how we should start paying off this debt. So in order to achieve this, it often starts with having a plan in place for debt reduction. So the first place to start typically involves looking at your budget and monthly cash flow and determining if there's really any kind of additional savings you can create by cutting any unnecessary expenses to kind of reallocate that and pay down your debt. So for those of us today who have never done a budget before, I would strongly encourage you to do that. Or if you currently don't have a budget, it's a great place to start today or soon, because it really kind of provides an eye-opening experience to see where is your money going to and where is it flowing to. So another area that you could look at is your current interest rate on your debt to kind of help with debt reduction. Are you able to consolidate your higher interest rate debt to a lower interest rate debt solution, which will assist in kind of paying more principal versus interest over time? So they're kind of two great areas. So these are kind of the two great areas to kind of start when we look at debt reduction. Many of you on this call today probably want your kids to have a great education, or your kids might have already expressed what university, college, diploma, or certificate that they would like to obtain. So education costs we all know it's increasing, and you might already have an RESP, or Registered Education Savings Plan, established for your kid. But if you haven't heard of this account, it is really a great phenomenal way to kind of save for your child's educational costs. So in summary, the RESP account, the government will match up to 20% on a maximum of $2,500 contribution per child per year since they were born. So the savings can grow quite significantly over time. In addition to all these financial goals that we've discussed too, many of us would probably also like to plan for a family vacation, or there may be other financial goals you would like to achieve. And having the ability to look ahead and to put a proper plan in place to achieve your goals will be very beneficial to your overall financial plan and overall financial well-being. So it would be great if you were able to say that, hey, you paid for your family vacation by diligently saving versus putting it on your credit card and having to take on debt. So financial planning it's all integrated. So we have to ask ourselves, how do our short-term goals impact our longer-term goals, right? And some of you may have multiple investment accounts. You might have some with the bank, or you might have with other financial institutions, and you probably have your group retirement savings plan on top of all of this. You have all of these accounts spread out in multiple places, but how do all these pieces kind of combine together as a whole to see whether you're on track to reach your goals, to reach your retirement plan, or are you contributing the right amount, or what do I need to contribute today to kind of achieve that retirement goal of yours? So again, this is kind of where your financial planner can help you in establishing a plan to kind of provide you with that roadmap, putting it all together, keeping you on track for your financial goals, and ultimately helping you achieve your important goals in life.
Taylor, talking about having money in different places and not necessarily all in one place. We did have a question that came in, and it's from an individual who worked in the UK for more than 3 years and has a private pension plan in the UK, and they think that they can transfer that money over here. Is that something that our team can help them out with?
Yeah, UK pensions, or if it's like 401ks or IRAs down in the US, they are a little bit trickier. The answer could be yes or no, depending on what type of pension it is. So maybe it'd be a great idea for this individual. Like, you are for sure able to transfer over to Canada. Sometimes the type of accounts, certain limitations do apply. So if, thank you for this question, by the way. I would strongly suggest that if you want to look into this further, reach out to Danielle, maybe provide us with your contact information, and we can kind of set up a one-on-one meeting to kind of explore that conversation a little bit further. But yes, it does not have to remain in UK. We work with clients who have pensions in Ireland too as well, where we're able to kind of transfer over. So again, there are certain restrictions and limitations, and they're very much pertinent to specific different type of pensions that you might have.
We can definitely take a look though and see if that's something that we
For
can
sure, yeah. We'd be more than welcome to do that for you. All right, so this leads to our next discussion, which is financial planning during our pre-retirement years. So during this stage of your life, what you will often think about and worry about will really be related to the biggest change which is about to occur, which is entering into retirement. So if you're in the stage of your life, you've probably most likely asked yourselves, when do I want to retire? Do I have the necessary financial resources to retire? Am I on track to retire? So you probably also ask yourself, how will my retirement look like? And I'm not necessarily referring to how you envision what you will be doing once retired, because I think we all kind of have that big dream at the end of the day in terms of what we want to do once we're retired. But more so, how do all of your financial assets support your retirement lifestyle? Again, kind of combining it and putting all the pieces together, right? How do all the moving parts all come together? These are very important questions which need to be answered. And you might find yourself in a situation where you might want to work part-time as you kind of ease into retirement. It's not uncommon. Or you might find yourself in a situation where you have to work beyond your preferred retirement date, right? And are there other financial considerations kind of leading up to retirement which you will need to consider? So, such as helping your kids, down payment for a house, very common among parents. Do you have renovations which need to be completed prior to retirement, or any kind of larger expenditures which will incur debt that should not be carried into retirement? So all these questions are important to have answers to kind of during the stage of your life. So this is why a retirement plan will help provide answers to your questions. It'll provide a much easier path and transition into retirement, and ultimately remove that stress and the uncertainties kind of leading up to retirement. It's all about financial readiness. And again, this is kind of where your financial planner seems like a broken record, but really your financial planner can really assist you in establishing a retirement plan to kind of create your roadmap, provide you with clarity surrounding your retirement, and answer the questions of whether you're on track to achieve your retirement goals. Ultimately, the main goal of having a retirement plan is to provide you with that peace of mind so that you can continue to live in the world that you have been accustomed to financially. So many of you may have a retirement plan put in place already, but it is important to do a regular review of your plan. For our clients who are kind of closer to retirement, we typically review the plan about every 2 to 3 years, or as significant changes occur and your plan needs to be updated at that time. So in retirement, most of you are probably aware that there are 2 government income sources which you can expect to receive. The first is the Canada Pension Plan, or CPP for short. And CPP is based on contributions you have made into the plan over your working years. So the average CPP benefit for Canadians at age 65 is $889.67 per month. And this statistic was as of January 2025. However, the maximum monthly amount you could receive as of 2025 is $1,433 per month. So again, what you can expect to receive in retirement is based on what you have contributed over your working years. Then we have the Old Age Security, or OAS for short. And OAS provides monthly payments to seniors who are 65 years or older. And it is determined by how long you have lived in Canada after the age of 18. So it's a residency and very much a year's determination that you lived in Canada. So as of 2024, the maximum OAS benefit, as of 2025, my apologies, the maximum benefit is $727.67 per month. And that's if you're between ages 65 to 74. And if you're over the age 75, the maximum OAS benefit is $800.44 per month. So unlike CPP, OAS is an income test benefit. So you need to be very careful on the amount of income you're receiving in retirement. Otherwise, there is a clawback amount. And the current amount for the clawback amount is $93,454 of net income. So for every dollar your net income exceeds this $93,454 threshold, your old age security pension is reduced by 15 cents per dollar that you're past that mark. So something to consider. And that's where looking at income planning and tax planning becomes very important during leading up to retirement and then earlier on. Mackenzie, yes.
Hey, Taylor. So I just had that question. So is that net household income or net individual income?
That is net individual income. So it's highly unlikely for an average Canadian retiree today to really just solely rely on CPP and old age security income to kind of fund their retirement. More so, you should be viewing CPP and old age security as another source of retirement income, in addition to the various different financial resources that we had previously covered. So this is why so many Canadians need to contribute to their company group retirement savings plan or their personal RRSPs and TFSAs. And everyone typically thinks that there's typically a magic number that you need to kind of retire. I see you're nodding your head, Danielle. That's probably a question that we get quite often in Mac too as well, right? This is a very common question that we get, right, guys?
Yes. Have I saved enough? Have I saved enough? Or am I?
Yeah. But really, again, it's one of those questions where in order to retire, it's a very personal, right, objective and a goal. So that's why everyone really has a different magic number. And that's why we have these personalized retirement plans that are done to kind of figure out, well, what is that magic number to say that if I retire at 60, 65, if I require X amount of budget, right, to support my retirement lifestyle, I need to make sure that I have this amount of financial assets to provide for that ongoing income in retirement. So it's very much a personalized number for a lot of individuals. So we'll now shift our conversation and look at a couple scenarios for retirement. And here we're kind of showing a retirement goal of $1 million. With monthly contributions, we're assuming a 6% rate of return on your money and retiring at age 65. So we're showing you what amount you will need to save today in order to reach that goal of having $1 million for retirement at age 65. So if you're an individual, say, who started investing at age 30, you would need to contribute $701.90 per month in order to reach that $1 million goal. And you can look at this as an individual or as combined household between husband and wife. And when we certainly defer when we start investing, you can see those numbers become quite astronomical and almost priced out of budget for a lot of individuals. So this is kind of really where we always kind of reinforce the benefits of investing early and having time work for you to allow that money to grow, and so that it's not putting a lot of financial constraint on you the later that you start to try to reach that retirement goal of yours. So as you can see there, the numbers get quite astronomical every decade that you're kind of deferring when you're starting to contribute towards your retirement dreams. So in this next scenario, we're showing the different income levels that you can expect to receive if you've saved $500,000. So again, you can view this as each spouse having $500,000 saved for a combined household income or a combined investment total of $1 million. So in this scenario, we've used a 5% more conservative kind of annual rate of return. We are including a 2.5% inflation rate. And an individual in a marginal tax rate of about 25%, and ensuring that there's enough income to last until age 90. So if you're looking to retire at age 55 and you got about 500,000 that you built up over your lifetime, and you say, hey, I want that Freedom 55, you can expect to receive about $1,749 per month in taxable income, or factoring in that 25% marginal tax rate, about $1,312. And again, that is monthly income provided until age 90. And this this chart here shows you the benefit that if you're able to defer retirement a little bit longer, allow your investments to continue to grow, and shorten that time frame which you need to rely on those investment assets, if applicable, the amount of income that you can receive over time will be quite higher than when you do retire earlier. So next here, we've kind of spoken a lot today, I guess, on having kind of a retirement plan. So I'd like to kind of expand further on this. And when we're conducting a financial analysis of a retirement plan, there are several key areas of consideration. So the first item includes establishing a budget, which we kind of talked about earlier in our presentation. And your budget will ultimately outline what amount of retirement income you will require in order to support your retirement lifestyle. So often the two largest expenditures during retirement can be costs for travel and vehicle replacements. So these need to be taken into consideration. Next, you will also need to assess all your financial resources that are available to you, which we had covered off this extensive list earlier. But more importantly, again, we need to clarify how all of these financial resources will fund your retirement, and again, doing so in a tax efficient manner. We need to account for inflation, which erodes our purchasing power over time. And we also need to consider the rate of return which you require on your investable assets to ensure your assets are growing at a sustainable pace, to ensure you don't come across a shortfall ultimately in retirement. So if there's any other significant changes to either one of these variables over time, it can impact your retirement plan immensely. And that's kind of why I alluded to earlier, if there are significant changes externally or and you mean yourself personally and your family, the plan should be updated quite regularly. So ultimately, the outcome of the financial analysis will show whether there is a surplus of retirement assets, which will allow you the ability to increase your retirement income potentially, or you may want to leave the excess to the next generation, which will then kind of involve further estate planning. The other outcome, which we hope to not find ourselves in, would be a shortfall. And if you find yourself in this position, though, the need for a plan really just becomes even more important So your plan can show you what needs to be done to get you on track in order to achieve your retirement goal or that retirement age that you want to set out for yourself. So again, really why it's important to create that retirement plan, review it regularly, and it gives you that extra time that if you find yourself in the shortfall, you can make any necessary adjustments as you're kind of entering into retirement. So the last slide here that we'll cover off with everyone is as we're kind of heading towards retirement, there can be certain tax considerations depending on your personal situation to ensure we're kind of in a tax optimal situation heading into and during retirement. So this can include utilizing your available RRSP contribution room prior to retirement. This would typically involve making a larger sum of deposit in which the tax deductions from this contribution can be carried forward to future years to reduce your income taxes while in retirement. So you would consider this if you expect a higher income from other sources of income earlier in retirement or potentially indefinitely. So this could be in the form of rental income from a rental property, or farmland rental income, or maybe you just sold your business. And I mean, those are kind of a few examples where this kind of type of situation might be applicable to you. Some of you might have unused carry forward TFSA contributions in which you would like to top up. So during retirement, TFSAs can be a great account to withdraw additional funds to kind of cover unexpected expenses which might arise. So instead of withdrawing these funds typically from your RSPs or your RIFs, which produces taxable income, it can be withdrawn from your TFSA completely tax-free. So your TFSA can kind of will provide you that non-taxable retirement income. And this is very important, tying it back to kind of the old age security where it has an income clawback threshold amount. So you have to be mindful of your retirement income that you're withdrawing, given that some government income tested benefits, such as the old age security or the guaranteed income supplement for some individuals who qualify for that too as well, just involves a little bit more of income planning and a little bit of tax planning around that. But once kind of an individual or a household has maximized their RRSP and TFSA accounts, there is really only one account where an individual can contribute funds into, and it's called a non-registered account. So this type of account is different than an RRSP or a TFSA in that it has the potential to produce annual taxable gains on the growth. So depending on the type of investments held in this type of account, it produces different types of taxable gains. So such as interest income, if you're invested into GICs or bonds or high interest cash, and interest income is typically taxed fairly inefficiently. And then we have capital gains or dividend income, which come from if you're invested into, say, stocks or equity funds, which are taxed more efficiently. So it becomes very important when we're doing some of this planning for our clients in non-registered accounts to kind of balance where your retirement income is coming from in order to kind of be tax efficient during retirement. So an example, I guess, I can provide everyone today when maybe this type of account would be a solution for you would be in cases where you might be selling your house to move to your cabin in retirement, or vice versa, selling your cabin and just living at home, maybe closer to healthcare for some individuals, or you may be selling farmland, or your business if you have one, or any other assets, larger assets with larger sums potentially, which you no longer require kind of as you're kind of navigating through retirement. Or even earlier too, so that these transactions will typically often have, again, larger dollar amounts, larger sums to it. And if you don't want to, or if you don't need to contribute into an RRSP, or if you no longer have any available TFSA contribution room, then you would most likely utilize a non-registered account, which is lesser known to maybe many Canadians or many on this call today here. So Yeah, we've covered a lot today. So I think it's we're going to maybe open the floor now to answer any questions which we may not been able to answer today. So maybe Danielle and everyone joining on this call and Mac will kind of open up the floor to any questions that anyone has.
Thanks, Taylor. Yes, lots of great information shared there. I think the common theme is, having that plan is just so important. I think, Taylor, maybe I'll get you to comment. I'm sure, you've had some clients you work with, throughout this time of uncertainty we've had in markets and in the economy in the last couple of months, really rely on that plan and get some comfort in having, a little bit of a roadmap or what to expect in the future. Would you say that's accurate?
Yeah, I mean, I think when we do the planning, like Mac and the big thing we always tell our clients is stick to the plan, right? Like as you mentioned there, Danielle, right? Stick to the plan, because oftentimes when you're looking at investing in its retirement assets, it's ultimately for a longer term goal. So sometimes we need to kind of drown out the noise of kind of the short-term volatility. Certainly when volatility arises, there are, opportunities that arise too as well, which certainly we can take advantage of. But it's not necessarily saying, hey, we're being spooked by the market, we want to sell out of the market, because it's common that in every typical year that we typically see a 5% correction twice in the markets, right? So again, I think the biggest focus sometimes is just matching your risk tolerance, like what you're comfortable investing in, so that you're not maybe seeing a big deviance. Like if you're conservative and someone has you invested, or you're invested in something aggressive, you shouldn't be seeing maybe that 15-20% loss, right? But again, remain invested, stick to the plan, because ultimately it's about longer term goals, and sometimes we just have to drown out kind of the short term noise.
Sure. Mac, do you have any comments there?
Not really a lot of comments. I feel like, Taylor, you're super thorough. The only thing I guess I would say, so when someone has a group plan and we're talking about gaps that may exist within the plan, how can someone become aware that there might be gaps within their group plan? And is that something that maybe you can comment on, Taylor, of folks bringing in their group plans to you to have that analyzed?
Yeah, I think a lot of times that's just kind of I guess that comprehensive service that we offer to our clients, because we do have to often look at things as a whole. So if you find yourself in that situation where, again, you have kind of different accounts, kind of different situations, you want to just get a second opinion, kind of what we call it, always kind of look underneath the hood. If it's been some time that you maybe haven't had someone do that for you, just kind of seeing if you're invested in the right areas from a diversification standpoint, right, geographically, from a stock to bond mix too as well. And I think everyone here is probably not uncommon that everyone's sensitive to fees, right? So maybe are you getting the most competitive solution out there too as well? So hopefully I answered that question there, Matt.
I think too, there's a bit of a convenience factor to that. I don't know anybody who wants to remember 6 different logins and get, 6 different year-end statements and remember where everything is. Things have changed a lot in the last number of years, and convenience is a big piece of that, having everything in one place. So if anybody, is interested in a look under the hood, you will have my contact information in the follow-up email that's sent out tomorrow. But with that, I just wanted to thank everybody for joining us here this afternoon. I hope you found a lot of this information valuable. We run these sessions typically twice a year, and we're always looking for, new topics or things that people want to learn more about. So in the follow-up survey, feel free to leave your comments there. We'd be happy to give you guys more content that you find value in. Awesome. Well, with that, I'll close it off. But thank you, Taylor and Mac, for sharing your insights. And thank you, everybody, for joining us here today.
Thank you, everyone. Have a good evening.